Welcome to The Foundry, where leaders are forged daily. Each week we investigate themes of leadership, entrepreneurship, and mindset with some of the greatest minds in real estate. And now, the data scientist of real estate, George Roberts.
Welcome back, passionate investing community. Today, I have the pleasure of interviewing Michael Pouliot, founder of Eon Capital Partners. This is a technology-enabled real estate business, and he's also the CIO of Carbon, a middle-market PE firm with over 15 years of experience spanning finance, consulting, and real estate. Michael's career exemplifies deep-rooted expertise and a commitment to excellence. Michael's journey in real estate began early as a fourth-generation real estate entrepreneur who spent his summers from middle school onward on job sites, learning firsthand from his father and grandfather. This upbringing laid the foundation for the deep knowledge and passion that continue to drive his success today. Now, Michael holds both the CFA and CAIA charters. We'll talk about what it means to be a charter holder and how that's impacted your investing experience shortly. He's also had a wide variety of professional experience, including some of the world's largest hedge funds, private equity firms, and financial institutions, including Goldman Sachs, Merrill Lynch, Cook Industries, Bank of America, and Morgan Stanley. And I think, I'd like to keep the introductions a little bit short because I really like to have the guests tell their own story. So before I bring Michael formally onto the show, I want to say that was written by AI. So my first question for Michael is going to be, did the AI get anything wrong? Okay, first of all, welcome to the show, Michael.
Thank you. It's a pleasure to be here. Thanks for having me.
Okay, so how did the AI do?
It did okay. I guess I would just for the sake of that this will live in forever in the internet. I've worked as an employee at JP Morgan, Merrill Lynch, those other ones, Morgan Stanley, Coke Industries that you mentioned, Goldman Sachs. Those were clients of mine. So a little bit, okay. Just want to make sure I don't get any trouble with the HR departments at any of these people. Not that I'm ever going to be an employee again, but don't want to mess up the powerhouses that are the traditional banks and whatnot. So
absolutely. And so the AI was only mildly hallucinating
right
there.
Yeah, a little bit.
So actually, yeah, when you signed up for this podcast, I think your assistant suggested, let's see what the AI thinks. So I think it's kind of apropos that we're starting out to talk about AI. I was going to introduce you by saying, we're going to find out today what the AI thinks, as Michael says it. But first, we're going to hear what Michael has to say anyway. So now let's just dive right into it. Gotta love it. AI, it's all over the place. My son uses it all the time, all day long. And I'm wondering sometimes if I'm a little left behind. But back to our guest, Michael. When you're at a cocktail party and somebody asks you, what do you do? How do you answer?
Well, I've got 3 young kids and another one on the way, so I don't make it to a lot of cocktail parties these days. But I would say, I'm a real estate entrepreneur, and so a lot of things that touch real estate, whether that be doing deals, working with our teams, managing our properties, or helping to educate individuals who want to jump into real estate or jump from, say, residential to commercial assets. So I think educate, lead, and do deals. That would be my favorite part of it is doing deals.
Yeah, we're all about doing deals. Usually I have the foundry where real estate deals are made, neon sign behind me. So
yeah.
we'll have my assistant put up a graphic for that. But yeah, making deals, a lot of fun. And we're going to talk about how your companies are really in many ways sort of media companies and how you're helping so many people learn the business. Well, I'd like to start by asking you, yeah, let's talk about the charter. So that was something we mentioned in the introduction. So you're both a CFA as well as CAIA. Now I had to look up the latter of the two, and it sounds like it's something that its time has come with alternative assets being so important these days and so important to this show. I always think that it's very important to understand finance, and I think that it really separates the big players in the game from people who may get stuck trying to build that giant financial empire. So tell us about what does it mean to be a CFA and CAIA charter holder, and how has that helped you to be a better investor?
Sure. Yeah. So I pursued both of these, kind of their postgraduate kind of charters or certificates in an effort to build my career on Wall Street. When I worked at JP Morgan specifically, I was working on their trading desk, and I was working my way up through from analyst to portfolio manager. And really, in order to do that, you had to pursue the CFA. And it's quite a difficult 3-level kind of program. It also requires 4 years of professional experience. I think roughly, 3 to 5% of folks make it through the entire program. And so for people that are working in banking that want to work in the front office, it's kind of like where you cut your teeth. If you got in, you did your undergrad, you got the job as an analyst. If you can get the CFA done while also working 70, 80 hours a week in the, every single week, then, hey, maybe you could do this next job too. So it's just another kind of gating function for the front office, essentially, and making sure that you can manage other people's money. So the content specifically is really like a foundational program around, first of all, ethics is a really big part. It's about 15-20% of each of the levels. And that goes through each and every level. They spend a lot of time on ethics of how you're managing other people's money and all of that, going through the process of figuring out what their investment policy statements would look like. Also just corporate finance work, fixed income analysis, equity analysis, all the common food groups that you'd expect from, a core program. And then the CAIA, to your point earlier, is more on the alternative side. So that's about, how do you value music rights or timber or precious metals or other types of illiquid or esoteric investments. And then there's, some math, but you can use calculators these days. So the math's not as hard as maybe it once was. So yeah, that's kind of and the CAIA is relatively easier program to get through. It's only 2 levels. And I would say probably about 30 or 40% of the people who start that get through that program. So.
Yeah, very cool. And I know that CAI covers real estate, cryptocurrency, private equity, and I think there's one other. So very, very cool. Like I said, something definitely its time has come. But I love that you mentioned music rights. So here, I just wrote a book last year, and I try to go through just in a very short way, take a survey of what private equity has to offer. Yeah, music rights. That's another. Very esoteric thing most people have not invested in. So passionate living through passive investing, go check it out if you can, and you can. So please do. So I'd like to ask you about your real estate investing portfolio because we do have a lot of viewers and listeners across private equity, but mainly a real estate show. So what would you say is the biggest lesson you learned in building a $1.5 billion real estate portfolio?
Sure. So yeah, my team and I, we've done over $1 billion of transactions. We hold a portfolio in $400 million right now. And I'd say the biggest lesson is that you can't do it on your own. So it really is about, it's not really about me. It's really about the team and being able to build a team that is incentivized and passionate about going out there and finding assets that are good opportunities, putting those assets together and those opportunities together, finding the investors, and then doing a great job by operating those properties effectively so that you can provide the returns to those investors. Because all the assets that we buy, certainly the ones that we've purchased in the last 7 or so years. I think in the beginning of my career, certainly I used my own capital, but quickly it's difficult to do that. And so you have to go out and find other people that are interested in investing in real estate and bring them along for the ride. And so it's really all about developing the teams, the operating teams, and then the financing side. So the investors who really become part of the team as well.
Yeah, perfect. The way you put it, you can't do it all yourself. You make it sound easy. But I feel it's a lesson you have to relearn at every level of your career. So any suggestions for people that are facing the issue of, wow, I can't do it all myself. What do I do? How do I let go? How do I delegate?
Yeah. So it definitely is something that every level, there's like another, it's like you're swinging from one rope to the next. And it's really hard, I think, to let go of that old paradigm of how you'd used to do things, because a lot of times you found a lot of success in however you were doing things. That's what's allowing you to go to the next level. And so to abandon that paradigm and move to the next level, I think can be difficult. And so I guess if you're just starting out, it really, to your point, it depends on where you are. But if you're just starting out and you're trying to make that first hire or delegate that first set of responsibilities, a personal assistant, an executive assistant is a is a great investment. It's not that expensive, and you can get some tasks off your plate, project management, bookkeeping tasks, just the things that just aren't worth, they're not your highest value tasks. They're not what you should be spending most of your time on. So really, that is, I think, something to be thinking about if you're just starting out, is hiring that first assistant. Don't look for your chief of staff or some COO or hey, to take over the core activities. That's a mistake that I've made in my career is, hey, can I find someone who can do what I can do better than me? The things that I do really, I may have like two or three things that I do really, really well. Well, what if I could find someone to do those things? Well, I've found out that those people want to get paid a lot of money, and it's a very high bar. There's a lot of things that I can't do very well, and that's a low bar. It's easy to get over that bar. So look for the things that you're maybe not so great at, that you don't love doing, and then those are the things you can delegate out to an assistant if you're just starting out.
Yeah, I love it. I think that's very, very well put. Of course, we should be hiring people that are better at what we do than we do it. And yeah, for me, it was like video editing. I love it, and I think I'm actually good at it, but I just don't have the time or the passion, or I don't want to say the discipline. I've got discipline for other things. I save that discipline for what really matters. And so I can have someone else edit my videos. That was one of the first things that I gave up. And I have my wonderful assistant producing this show, and that's very much appreciated. All the post-production.
Mm-hmm.
All I have to do is study up amazing people and have fabulous interviews. So I know that you mentioned doing over $1 billion of transactions. Like many of our guests, a lot of that I think is in commercial real estate, but you also invest in residential. So tell us, why do you invest so widely? Why commercial? Why residential? Why not just stick to one?
Sure. So I think at this point, we really are focused 100% on housing. So whether that be single family homes or small apartment complexes, primarily when we're working with mostly our students in our community, where people are just starting out or they're just developing their careers. However, when for our private equity business, we are focused very specifically on middle market deals between 10 and $50 million, primarily vintage apartments in growing markets around the United States. So we do very
Is it
much
vintage?
focus. 70 to 90. When I say vintage,
70s
I
vintage.
mean like
Okay, got it.
older vintage, older properties, kind of not new construction, mostly
Right,
70s to say 2000 vintage properties between
right.
100 and 300 units.
Right. When I was starting out in commercial real estate at the beginning of this decade, that 70s was still considered, not so old, but with insurance in many places. And of course, LA wildfires is only going to make that worse. 70s is now considered old,
Hmm. Hmm.
much more so than it was even 5 years ago.
Hmm.
Yeah. Wow. Yeah, definitely different set of problems with each vintage of properties.
Absolutely.
Well, you've mentioned, I think, a few times now that you're involved in some coaching, some media, etc. I know that you host the Deal Flow podcast, and you have a free school community called Dealmaker. That's spelled SKOOL if you're looking for it. The Dealmaker Fast Track for people who want to do their first real estate deal in the next 90 days. So, what I'd like to ask you about your programs, what is your unique value proposition?
Yeah, so I think what's unique about what we do is, yeah, we try to get people to their transformation as fast as possible and really get to that first win as fast as possible, but while also laying a really strong foundation in the principles of investing. So I think that you can do a disservice by trying to get someone to get to their win, but not really understanding the fundamentals of how that works so they can repeat that. So it's not just about getting them to their first deal in 90 days. It's about creating a system that they can execute on over and over and over again. So while they're getting that first quick win, we're also helping them build up those initial systems so that those systems will pay off over time and they'll be able to get more and more deals done if that's what they want to do. Some of our clients want to become investors on the side. Some of them want to just have one deal a year, and we can create a system or help them create a system that, executes on that goal.
I like it. I feel like a lot of coaches, they give you sort of a program. Hey, this is how I did it. Do it just like I did. When I walked to school as a kid, I marched uphill in both directions, right? And then you do talk a bit about personalizing, and I think that's perfect because I like the idea of right sizing your real estate. I mean, who knows? You may have another job, you may have obviously other demands in your life. So the idea that everybody's just going to get into this and just grow and grow and grow, because maybe that's how the sponsor of the program did things,
Mhm.
may not work for everybody. So I like that. So that is very cool.
That's
Very, very
definitely like
cool.
a, I think for 90, 95% of people, right? They're not going to become full-time investors necessarily, but they can still have, I don't think they should, right? I don't know that it's necessarily a good thing. Not everyone needs to become a real estate investor full-time in order to get the benefits of real estate. You can buy one asset every year for the next 10, 20 years and have a really nice cash flow, $10,000, $20,000 a month from that portfolio in your retirement, which for most people is kind of a better route than becoming a landlord and needing to, deal with tenants and toilets. So yeah, that's I recommend, yeah, it's sort of a personalization approach. Really think about how do you serve the client or the student in the best way possible versus trying to like fit them in a box, right? Based on how I did it, which was somewhat of a unique way.
Yeah, I love it. No one size fits all. So that's beautiful. Well, we are talking about housing today, and I'd like to ask you then separately about the housing market. How do you see the housing market in 2025, first for multifamily and then separately for residential?
Yeah, so there's a lot of different things there. I think if we start with commercial, we're starting definitely to see a significant level of distress in several parts of the commercial real estate market, including apartments, including office, including hotels. There's a couple factors going on there. You've got the rising interest rate environment, and then a lot of deals getting done in the 2021 vintage where prices were extremely high and people took out a lot of debt and debt funds were, very liquid. And so you have a lot of debt coming due, a lot of properties that are moving past their maturities and moving into distress. So we're seeing, 10, maybe even 15% of those particular assets, office, hotels, and apartments, depending on the type of debt they have. It's not don't well, maybe you can quote me, but just be the source of this may be non-agency CMBS debt versus maybe agency debt has a lower default rate. But you definitely are seeing a lot of loans going to special servicing, a lot of deals trying to trade at or below the prior sponsor's basis, or even, under the debt balance. So I think that presents a lot of opportunities for sponsors who aren't coming through this period with a lot of distress in their own portfolios. They can take advantage of that distress by acquiring properties at a good basis, either from the sponsor or from the lenders. And so we're seeing a lot of opportunities like that. The last few deals that we purchased, we've been able to acquire below the basis of the prior owner and with a lot more improvements. So we've got a property at a better rate basis that's already been improved with a lot more room to run. So we feel like 2024, 25, and 26 are going to be great years to buy commercial assets if you have the right, platform. And then moving over to residential, I think it's a little bit of a different story so far as what's going on with distress. I think there's less distress, but the story is still, framed out by interest rates. So the fact that interest rates are so high makes affordability a concern, difficult for people to become investors or homeowners. And at the same time, there's a limited supply in the markets where people want to live. And as a result, you've got higher and higher prices. So there's an affordability crisis in America. I think we all know that. It's difficult. And there are places where it is affordable. Unfortunately, that's just not where people want to live. And so in the places that people want to live, it's not that affordable and there are not enough houses. And then there are places where it is affordable and there's availability, but people don't necessarily want to move there and whatnot. So that's, I'd say,
I'd love to
what's going
expand
on
a little
today.
bit on that
Yeah.
affordability issue because I think there are a lot of places that are somewhat affordable. I like Kentucky, Tennessee.
Mhm.
These are some places that are somewhat affordable that actually do see people coming in there, maybe not pouring in like Texas and Florida, but definitely attracting population. So, where do you see affordability as playing a role in this issue?
Well, I think on the investor side, so I agree with you that there are places in the United States where you're seeing affordability. I think I like the markets that you just mentioned. We're also seeing we're buying deals in Alabama where we're seeing affordability and great opportunities for folks, as well as some other places in the Midwest. I think more and more in the most recent bull market, people were all about the smile states, all about the Southeast of the United States and the Southwest. And now we're seeing overbuilding in those markets, and you're seeing insurance problems and natural disasters. And I think that, the Columbus, Ohio's of the world that have the last big freshwater reserves in the United States, limited natural disaster risk. As you move into the 2030s and 40s and 50s, and you think about where will people want to move, I think that they might consider moving away from coastlines, away from natural disaster risk, and sort of back to the heartland of America. And so, but that's a sidebar, migration trends. But going to the question of affordability, I think how that affects people is, there's limited cash flow. So if you're an investor trying to go into a property at a price that's just not affordable, you just can't pencil that out. You just, if you want to get a certain amount of cash flow, it's really hard to achieve that. And the owners of those properties are just not willing to capitulate down to prices that would allow the next investor to get a good yield. And those investors are competing with homeowners. So homeowners are happy to pay, well, maybe not happy, but they are paying those high prices that just don't work for investors necessarily. So I think it's harder and harder to find opportunities as an individual investor, especially on the MLS or on market sources where you're competing with the traditional home buyer.
Yeah, well, I love that plug for the heartland. Here I am broadcasting to you from the heartland of our country, just north of Detroit, Michigan. So yeah, I do think that in many cases, Midwest is a great place to invest in. A lot of cities that I like, a lot of markets that I've mentioned recently. So I won't repeat that, but I like your picks. Or at least I say I like to hear people's picks. I like to hear why people invest. I know a lot of people investing in Columbus. I haven't done that one yet. Uh,
The first 1,000 multifamily units, well, maybe not, close to the first 1,000 multifamily units I acquired were in the Chicagoland area in the suburbs, and those deals treated me really well. And I think at that time, and even still today, that was a contrarian bet. But ultimately, the deals performed really well and didn't get as much volatility as some of these coastal markets where you're seeing wide swings, going from 3 caps up to 6 caps. You just don't see those swings in some of these Midwest markets where maybe you don't have as high a population growth, as much rent growth, but you just don't have that beta that you would experience, the high beta that you'd experience in some of these high flying markets where you're seeing all of the oversupply and the new building, like the Austins of the world, for instance.
Speaking of beta, one of the slogans that I've been hearing a lot over the last couple of years is survive till 25. Now we're in 2025, and it seems like we need a new slogan. Do you have any, you want to take a stab at that?
I don't know if I have a new slogan necessarily, but I think it's with property, the longer you can hold on and
Yeah.
maintain positive carry, the better you're going to be. And so I think if you did survive to 25 and you were able to refi out of your deals, I think you did, you're in pretty good shape. I think a lot of deals that should have matured in 2024 are now in special servicing or have needed to get extensions. And so they've extended their way through 25, and now maybe they'll have to limp their way into 2026. But, I think we're getting to potentially the end of this, cycle as it relates to the debt, the short-term debt problems that we're seeing. So a lot of maturity walls that are being hit either last year or this year. So it's not like we're going to continue to be talking about this in 2028. These deals will get worked out. They will move to new sponsors. The equity will get reshuffled and they will have their day. It's just in real estate, unlike the stock market that moves, all the time, very quickly. Real estate, illiquid assets, they move very slowly. There's a lot of people involved. A lot of mindsets changes have to occur before people are willing to capitulate around, some sort of disaster that they have to deal with. So I think it just takes a little bit of time, and but I think we'll see most of these deals work out over the next 6 to 12 months, maybe 18 months, if they haven't already.
Right, I like it. So I'll just share this with you. I've been thinking about this, survive until 25. The best I was able to do is thrive after 2025. How's that?
That's nice. I like it. Yeah,
Yeah,
well,
I don't know what rhymes with 26 that
yeah.
has anything to do with finance off the top of my head. But yeah, I think that we definitely do appear to be towards the top of this interest rate cycle. And yet, I want to say it was yesterday, 10-year Treasury 4.77, saying this in the middle of January. And I heard somebody say a few weeks back that the 10-year won't go above 5%. And I thought, what a lame prediction. I mean, can I make a living making predictions that lame? And now I'm thinking like, wow, what a bold prediction. You got financial analysts predicting that the 10-year won't go above 5%. Now we don't know. All right. Well, thank you so much, Michael, for taking the time to share your knowledge and experience with our audience. I think we're going to cut the first half of the interview here, but in the second half, we're going to have a lot to say about multifamily, single-family markets, where they're headed in 2025. We're also going to talk a little bit more about leadership and entrepreneurship and ways in which you can become better at both and grow your business. For the time being, thank you so much. And just want to make sure that our listeners have the opportunity to reach out to you. What's the best way to do that, Michael?
Sure. Just go to michaelpouliot.com. The spelling will probably be in the show note. And from there,
It will.
great. And then, from there, you can join our free school community where you can learn how to become an investor or how to level up your game. Or you can apply to be a guest on one of our podcasts or just connect with us or follow our articles and subscribe to our newsletter. So michaelpouliot.com is where you can find out all that information.
All right, beautiful. Thank you so much, Michael, for taking the time to share your knowledge and experience with our audience.
It was a pleasure to be here. Thank you so much for having me.